Is Altria Group stock ticker MO dividend payment safe? To address this, let's go ahead and jump over to my dividend breakdown spreadsheet that is powered by Ticker Data. And like always, if you'd like to get access to any of my spreadsheets and the Ticker Data Google Sheets add-on, then you can click on Ticker Data at my link in the bio. But let's go ahead and come up here and plug in stock ticker MO and hit enter. And so immediately we can see this is a massive dividend payer. This stock has a 9.43% dividend yield, and we also need to keep in mind they've been increasing dividends for over 50 consecutive years. So it's obvious why some people would have concerns. We see a high starting dividend yield right here sitting at 9.43%, and then look at these payout ratios, 83.56% and the free cash flow payout ratio sitting at 74.57%. So a company with a long history of increasing dividends, high starting dividend yield, but high payout ratios. Obviously, this is not worth investing in if the dividend isn't safe. So to find out if it's safe, we need to dig into this just a little bit more. First off, if we come down here, yearly dividends, we can see really nice history of increasing the dividends by a decent amount. They have a 5-year dividend CAGR of 3.63% and a 10-year dividend CAGR sitting at about 7%. So overall, pretty solid dividend growth for a company with that high of a starting dividend yield. But again, we need to address these payout ratios. Well, if you start to dig into what management's expectations for the dividends are just a little bit more by looking at some of their recent earnings report and investors' presentation, you can get a lot more insight into what the strategy is with the dividend at Altria Group. First off, let's look into a report they put out in 2022. You can see they declared that we maintain our long-term objective of a dividend payout ratio target of approximately 80% of our adjusted diluted earnings per share. Now, future dividend payments remain subject to the discretion of the board. Now, this is really good insight because all of a sudden we can see the payout ratio isn't actually sitting at 80% just by chance. This is actually what the management team at Altria Group is targeting. They've decided that as a more mature business, the best way for them to reward their shareholders is in the form of paying out dividends. And if we jump over to another report, we can see since 2010, Altria has targeted a roughly 80% payout ratio of earnings to dividends, which is among the highest in the S&P 500. And at its Investors Day around a year ago, the company shifted to a mid-single-digit growth target through 2028 in what the company said was a sign of confidence. Okay, so that's more insights for us to look at. Basically, they're telling us mid-single-digit dividend growth, which is kind of in line with where their 10 and 5-year dividend CAGR has been at. Now, for them to be able to increase their dividend payouts over time while maintaining a payout ratio of around 80%, obviously, the free cash flow is going to have to grow over time as well. And we can see the 5-year free cash flow CAGR sitting at about 4.6% and the 10-year sitting at about 8%, which both of those are high enough to sustain dividend growth. So if we come down here and look at the free cash flow earned by the company versus the dividends paid out, for the most part, it looks like they've done a pretty good job of generating enough free cash flow to cover those large dividend payments. For example, in 2023, this company generated over $9 billion in free cash flow and paid out around $6.77 billion in dividends. So yes, the free cash flow payout ratio is high, but the free cash flow has been growing at a rate high enough to sustain slight dividend growth. And if we look at the free cash flow payout ratio chart over time, we can see since 2018, this company's done a good job of staying within that free cash flow payout ratio that they are targeting. Now, if we zoom back a little bit, we can see it does look like there was one year in 2016 where the free cash flow they generated did not cover all of their dividends paid out. So free cash flow did not cover in 2016. That's not a good thing, but if it's only 1 year, it's not necessarily a huge red flag because the rest of the years we can see free cash flow did cover that dividend payout. So when I look at a company like Altria that pays out massive dividends, starting yield of 9.43%, it's easy to see why people would be concerned at first glance with really high payout ratios and really high free cash flow payout ratios. But the more you dig into this, you start to understand this is part of the capital allocation plan from the management team at Altria. They've decided the best way to reward their shareholders is in the form of dividends. So while this won't be a fast-growing company in the future, I do think you can feel good about these dividend payments being safe for the near future. And you'll even see some dividend growth as well. Now, like always, if you'd like the ability to automatically pull in stock information straight into your spreadsheet and get access to any of my spreadsheets to download, then you can head over to tickerdata.com at the link in the description. So that being said, thanks so much for watching, and please don't forget to like and subscribe to the channel.